Hello investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk to you about LendingClub. So LendingClub is essentially a bank, yet it describes itself as a fintech platform, and this is kind of like where the bullish and the bearish argument come around. So from the bull's perspective, LendingClub should be viewed as a fintech and be priced on a fintech multiple. The market at the moment appears to be pricing this as a bank. So, the two sides of the argument there. But this is one of those companies that there's a few of them already around that is kind of like a neobank and trying to make a lot of loan originations, drive revenues. But ultimately, what the market is going to reward is the very strong growth in earnings. And in this event, I can make, looking for the guidance, they're going to grow their income line quite significantly. Anyway, I get ahead of myself, so let me just kind of jump in right here. So, LendingClub has been battered in the last several months. This has been, the story of so many companies. In and of itself, I would not consider this to be all that meaningful if it wasn't for the fact that the valuation, in my perspective, is slightly stretched here. Now, when I think about LendingClub, right, so you can see here, so the guidance for Q1 points to 150% year-over-year growth. Very, very strong. I have no doubts of that, okay? So if you compare that to the same period a year ago, they were at negative 19%. Now, with that in mind, of course, when you come up against a negative period in the previous year, it's always going to be an easy comp. But as you can see on the far right, for fiscal 22, they're pointing towards 47% year-over-year growth. Now, the company is clearly, they had the acquisition of Radius in February, so there was some kind of inorganic growth coming in there as they acquired a fully regulated bank. So the way I really kind of think about this is that the market doesn't like this, and the stock has sold off approximately 12 or 15% in the after hours. And the way I would really sum it up is that investing is so often new, but it's always humbling. And it's difficult because if you're a shareholder here, you're kind of like, man, you've already taken such a large beating, and you're kind of like, no, I don't want to give up. And the person's kind of like fully entrenched, and I get that, we've all been there. And the problem here, as I can highlight for you, so if the company is expecting to grow at approximately, let's say, 40, 45, 47% over 2022, and the first quarter they're expecting to grow at 150%, that implies that the remaining quarters, they must meaningfully sell off. So this is analyst expectations for LendingClub. But even if we say, okay, let's say that these numbers are slightly low, okay, let's say that they kind of end up being a bit stronger than this, we are nevertheless likely to see a huge step down from Q1 into the Q2, Q3, Q4. We're going to see the company going from triple-digit growth rates to like mid 30s, and then kind of trickling down to like the mid 20s. And that kind of poses a problem for investors, because if this is supposed to be like a fast growing fintech company, and you kind of having really unsustainable growth rates and highly unpredictable revenue growth rates, you're kind of like, okay, I'm not going to pay a premium for that, because you ultimately have no idea how this is going to come out post 2022. So that's one side of the argument. So I've already kind of batted around this a lot. What LendingClub declares is that because they have such a large loyal base, that they're able to help them by providing them with a super app that they can control their spending, they can control their savings, and it's just a place where you can really coordinate all your financial activities. During the earnings call, management talked about that 2022 is going to be a record year for the company. And they also said, okay, investors, you should really be focusing on our strong bottom line growth. Now, this is where I do think that the market should be given a lot of value to, okay? In the previous year, in 2020, LendingClub was reported GAAP net income of negative 188 million. Okay, then for this year that just finished, 2021, they reported positive 19 million. That's a huge swing from negative 188 to positive 19. Looking ahead for the remainder of the year, they're pointing to approximately 140 million of net income. Okay, so for a company that just reported 20 million, for them to report about 140 over the coming 12 months, you're looking at more than a 10x growth on the bottom line. Really, really aggressive growth on the bottom line, which should be given some value by investors. Furthermore, if you think about it, I'm not a macro investor, but I do understand enough about the impact of raising interest rates on banks, and they're saying yes, our funding costs is already incorporated into the guidance that we're providing for investors, and that we're going to look to offset those higher funding costs by serving higher yielding customers loans. So to come out and say that that they're going to grow their bottom line by 10x, I think that's very, very valid. Now, when it comes to valuing this, cheap doesn't always mean that there's value there. So, we as investors have become quite accustomed in tech to consider investments on a price to sales ratio, okay? But not all businesses should be valued on a price to sales ratio. LendingClub, the argument could be made that it should be valued on a bottom line profitability capacity. But the problem is that this is really a bank. And if you were to say, okay, LendingClub is a fintech business and is priced at 16 times forward earnings, you're like, wow, fintech, 16 times forward earnings. Most businesses are priced at 16 times forward sales, so this is terrific. But if we say, okay, ultimately this is a bank with a highly leveraged balance sheet, it should really be viewed as a bank and valued as a bank. Banks trade on a multiple to book. And in that event, most banks would trade approximately 1, maybe 2 times book value for a particularly high quality bank. However, as it stands right now, LendingClub is valued at approximately 3 times book value. So even if we kind of say, okay, the book value is going to grow substantially, and you take that aggressive assumption for the remainder of the year, it's still going to be priced at 2.5 times book value, which is really, really at the high end of what a bank should be valued at. And I have in the past been invested in banks, so I know very well how this can so quickly swing around. So I don't know. I personally will not be getting involved here. I know that for many people, they don't like to see a negative view on their stocks, and I get that. I also recognize that it's important to kind of lay out what I think, and I'm highly confident that LendingClub will continue to see its bottom line profitability grow over the coming year. But you have to think whether the bulk of its growth is going to come from being simply a bank. If that's the case, I believe that the stock is already very fairly valued. If you kind of want to find out other names that I do find quite interesting to invest right now, don't forget to check out my marketplace. The name is right there above the screen, Deep Value Returns. I help you by giving you high quality, actionable investment insights. You're welcome to check out the reviews that other people have given for my platform. And I hope to see you next time. Happy earnings season, everyone.